What is up, guys? This is gonna be the third video. This is gonna be the second part to the beginner price action introduction. We kind of tapped in a bit to market structure, which was the main thing. That's one of the most important things that you're gonna have to learn last video. And in this video, I just kind of want to go back on that a little bit and go more into market structure, kind of. But more than that, I want to show quick examples of what the finished product can look like. Like what, with all the concepts put together, what you can begin to see in price and how you can map your way through it. So we're going to look at this same example. In the last video, we talked about basic market structure with in an uptrend, you have higher lows, higher highs being formed. Downtrend, you have lower highs, lower lows being formed. And then you have accumulation, you have distribution, and those are the four stages of the market. So in this video, I'm going to take it up to this rollover in price right here. Yep, right here. And kind of go over how even with no past data, nothing this price here was tapping into the past, no old supply, say an old supply zone left behind that price could have been tapping into, and another example to then take it short off of that and wait for this distribution, wait for these breaks in internal market structure to show you the shifts in order flow before the big move happens. So I'm going to be going more into like why I think I'm going to make videos like on market structure, for example, more like the mechanics behind it at some point. That's probably going to be coming out soon. But for now, we're still in the beginner stages. So here, like we said, we were in this uptrend. We broke this higher low here to the downside. And now we're under the assumption that price, because keep in mind, on a lower time frame, I'm always going to say this, time frames suck. You have to know, instead of looking at time frames the way that most people are looking at time frames, you have to look at the proper structural play that's in motion at any given time. And sometimes that will appear on a higher time frame, sometimes it won't. Sometimes it'll be on a 1 hour time frame, sometimes it'll be on a 15-minute time frame. But you're always going to have structure with inside of structure. And that's kind of what I wanted to tap into a bit more today, or in this video, I mean, with the fractal concepts. So here we have higher highs, higher lows. We're in this uptrend here. We broke down to then pull back into supply, wait for our distribution. Remember, distribution to go short. Now, at the same time we're waiting for distribution to happen here, you could say that this entire area, this entire range is being distributed into. It is moves with inside of moves. And essentially what I mean by that is if we look here, this uptrend example, what that would look like on lower time frames is price moving really high away from this average price point or whatever, pulling back in, giving new highs, new higher lows, new higher highs, to then distribute up here, to then go short into a downtrend, to then accumulate at a bottom, that bottom being at old demand, to then continue that uptrend in that external leg in price. So let's take this, for example, to look at that. So uptrend shifted to the bias. We are looking for shorts now that we have this lower low under this higher low. So on this time frame, on the daily time frame, from this low up into supply left behind by this move up, this up move before this rollover being in here. This is supply. we are looking for price to come up into it to then distribute and go short. So on this time frame, we could have said this here is all one leg in the sense of this. This is valid. This is all one uptrend. This is all the same structural play. Where at the same time, you could have said on an even higher time frame, say a weekly or monthly, it would have looked like this, just a straight line to the top side. So time frames don't exist. What does exist is a price ladder, and that price ladder is going to have shifts within it and moves within moves that occur. And the algorithms are always going to repeat the exact same pattern for long and short over and over and over again, every single move in the market, and every single move is going to have moves within it. We need to figure out how we can decipher it, essentially, read it properly, to then trade it profitably. So, lower low forms. Keep in mind this line here being what that would look like on a higher time frame, just one leg up. Whereas on this lower time frame, what do we see? We see this. Now notice low, high, higher low, higher high, equal low. This is what I talked about in the last video. We didn't wick down under this low, but we did tap into it in the equal low. This is what retail is going to see as a double bottom or a double top. And sometimes it works out because they're catching the proper fractal move. But other times, the majority of the time, they are not. Let's see if we can find an example. So like right here, a double bottom or a triple bottom. Boom, 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 or however you would view that. Or here, for example, yes, we did get some mitigation off of this double bottom right here to then go a bit higher, but then notice what happened. Price pulls back and grabs anyone that went long here with their stop underneath, or here, grab their orders. So that is a very slight introduction into why I think all retail concepts are bullshit, and we'll get more into that later. Not to mention trend lines and all that other garbage, but essentially uptrend. Even though we are biased to come up into here and go short, we still have all four stages of the market play out within here. So here we have top, this being distribution, downtrend, lower lows, lower highs being formed, accumulation, and an uptrend. We have all four stages. Now within that, we have even more moves with inside of moves that repeat the exact same thing over and over again. Let's say right up here, for example. So we come up, this is an uptrend, low, high, low, equal low. Here we wicked under, notice that, grab those orders, send to the top side. Then we distribute, go short a little bit, distribute, distribute, go short, go short, go short, accumulate, go long. There are moves with inside of moves. You need to, this is key. You have to know how to read that. Because if you can read that and you're always picking the proper leg of structure, the proper range that you're reading in price, then you can get very accurate with your trade. So here we're still in an uptrend. No structure has been flipped bearish. We go forward a little bit. I don't know when this thing rolls. Notice we broke this high here, boom, boom, while at the same time this could just be what I was talking about in the last video with an equal high absorbing orders directly above it into supply. Notice that gray box there is marked up essentially as supply. Pretty unrefined zone, but we're not too worried about refinements just yet. To then come in and distribute, and then notice what happens in here. I'm going to get rid of this line, but keep in mind, actually I'll just leave it on there. Keep in mind, we are, oops. Bear with me here for a second. right in here-ish. So on a higher time frame, leg low into anticipated leg high. To then take it short, on the lower time frame we have low, high, higher low, higher high, equal low, essentially a higher high, continuing that uptrend to the top side. Now watch what happens whenever we tap into supply. We've formed this double top. Don't worry too much about that yet, but again, I just want to get the concept there because we will be coming back to that. Now notice from this low we have low, high, higher low, higher high, higher low, higher high, break to the downside, slight, testing back into this old range here to accumulate and send it higher. If we would have went under the assumption that as soon as this low here was broken by this to then pull back into here to go short, we would have missed the trade. We would have lost the trade because we're not reading the proper leg and structure. And that's what I'm going to teach you how to do. I'm going to teach you everything ground up, how to read every single piece of price. So notice as we come in, we form that double top absorbing the orders above it. We're in supply. Now this is looking like distribution to me to then take it short. Okay, how do we confirm that? We look for Wyckoff. What do you see in here? If you pull up a picture of Wyckoff distribution, this looks exactly like that. Then we come in, boom, we start to roll. We're breaking under the low that caused our highest high here. Boom. Now we're waiting for a pullback into this area to take it short. We come in, notice what we do again. Directly after that, we come back up into this supply up here to breaking this low. This low here is broken right here. We come back into supply to then go short, but we also at the same time created equal high, absorbing the orders directly above, grabbing liquidity. Manipulation is what most people are going to call it. This would have been a perfect short entry to then target. Say you want to refine that even more. We would have been targeting down here, but say you want to refine that even more, you can come in to right here on a lower time frame. I don't know how low this will let me go. I don't want to go. I'll stay on the 15-minute. And you notice low, high, higher low, higher high, higher low, higher high, higher low, higher high. The highest high right here. The low that caused that is where? Right here. Price breaks down, breaks down, breaks down. We can look now for the exact same thing if you miss the short up here that we were looking for with this move up to test back into supply. So what would that look like? The last up move before the down move. I personally would have said in here, or if I wanted to leave it less refined, I guess I'm just going to leave it as that. That's pretty refined, honestly. That's not even bad. Also notice, again, I haven't really explained too much, but keep in mind imbalance candle here, increasing our probability of this thing continuing short. Now, if we missed any of the shorts up in here, we wait. Price does what? Wicks up into fill this imbalance candle, tapping into the last up move for the down move, supply, boom, 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 supply, to then continue short. Our stop loss, we got in on this late entry. This is a very late entry. Could have been right here, right above supply. Or you could have loosened it up a little bit under the assumption that we might come back up, form equal high into the supply to then go short, and that's totally fine. To then target our external next low, because now we're under the anticipation that this price up, break, pull back in to now continue, and now we're targeting these lows here, and then with runners, after you take partials off of your trade, you can target even lower, such as down here at 47K. So what would that look like? That would be a 26 RR trade. Or if you want to go target even more, assuming that does get rained, say you have takeoff partials at it would be, I would personally take partials the instant we tapped under this low here, target here, target down here, and then say I have runners left and I target down here, I take off even more my position, and then as price evolves, as price plays out, we know, okay, if this huge leg is shifting bearish, we are likely to run these lows, these lows, these lows, potentially all the way down here into 20K. But we'll just target right here. Okay, play through price a little bit. This here, you don't notice already, I'm sure some of the people in the group already notice it, would have been another entry, testing back into the exact same thing. This supply left behind by this move up for this roll that broke structure, boom, boom, to then test back in, distribute, break lows, pull back, boom. So there would have been a short here and another short here, because we're not trying to catch. You don't have to try and catch from a low to a high, or a high to a low from point A to point Z. You can catch a move from point A to point B, and then with runners, with partials, after you take partials, you can allow your trade to run and then play out and give you that A to Z, or that A to whatever. This big external move is where the money is made. And when that happens, that's where your account grows massively in the span of sometimes just a few hours or even a few minutes. So as price rolls, say, we'll just say we're holding this short. I won't even throw on these two. I'm seeing more entries already, potentially right here. Notice the exact same thing. Supply, roll, breaking structure here, boom, boom, breaking structure, pulling back into supply, giving us this equal high absorption to then continue lower. So already within this, I'm not even looking at anything under the 1 hour time frame. I'm seeing at least 4 entries that I've already mentioned into this trade, whereas most people would be trying to catch something like this in just one trade, or even less RR, because most people are aiming for really higher win rate than they are finding their RR, because they just don't know how. But this is the stuff that you're gonna see gurus on Instagram and Twitter and Reddit and wherever the hell posting bullshit trades where they say they're hitting this RR, and I'm telling you that's not consistent. That's not something that you are going to hit. What you can hit is this, but after you've taken partial, rolled break even, and then allowing the trade after you're already taken out at least half or more of your position with that remaining 50% to let it run like this, instead of trying to catch A to Z. Whereas after you break even on this, you're risk-free on the trade. So now you can look for even more entries. So then you can go, okay, I want to take another entry right here. And that's totally valid, and that's totally fine. So instead of trying to catch A to Z, you're trying to catch A to B, and then B to C, and then C to D, and then in hopes that any of those trades can evolve into an A to Z trade, or a B to Z trade, or a C to Z trade, if that makes sense. So that is how I trade, and that's just a slight introduction into how fractals in the market play out, and kind of an introduction onto what you're going to be studying more than anything. What retail would be seeing in here is bullshit, like trend lines, and I don't even know, like, oh, look at this friggin' triple top or something like that. But if you look back through price and you just go and test trend lines out, like look at, say, this trend line right here from this low up through here, held, 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 price taps back in, runs it like a motherfucker. Why? Because this move down was essentially clearing money, FOMOing people into longs, all the way up through this price after they were short from down at 20K, 30K, 35, 40K, 50K. They're like, we just fucking ran 50K right here. And now we're ready to go to 100K or 500K. And then retail sentiment sets in, FOMO sets in, people start buying it up, while the algos, the smart, the people who are running the market, the big boys, they're flipping order flow as that happens. And we can read that and we can react as it plays out. Because these trend lines, yes, they may work for a bit because you're catching the proper fractal move. But as that move evolves, those fractals are going to switch up. And then moves with inside of moves are going to start turning into moves with inside of moves, shifting in the direction against your bias. So I'm going to start going deeper into fractals probably in the next video, but I just wanted to kind of get that out there and show you guys what that was like. So for now, keep in mind the 4 stages of the market, which is uptrend, distribution, downtrend, and accumulation. And that is all I have for this one.